So coming out of Q1 in the convertible space, we saw 18 issuances to raise just over $10.5 billion. And for the first time in a long time, we saw a significant appetite, both on the institutional side and on the corporate side for investment grade issuance. And Mariano, what do you think changed over the first quarter, and what's driving that demand and appetite for investment grade paper in the market?
The first thing that comes to mind is rising interest rates. Rising interest rates have had an impact on all financings across the board, whether it's for high yield companies or investment grade companies. They've had an impact on fixed rate debt, but importantly on floating rate debt. And we find so many issuers, including in the investment grade space, looking at ways to prepay floating rate debt and replacing that with lower cost fixed rate alternatives. The convertible comes very handy to do that because we are able to subsidize the funding rates significantly by selling that equity option. But this wouldn't be attractive if it was dilutive alternatives. What we find is that in the current wave of convertible issuance, we are issuing converts that convert primarily into cash, not shares, combined with a call spread alternative that we have or solution. It is that we can provide very debt-like, non-dilutive, lower cost alternatives through the convertible. So it's not a surprise that we're seeing so much interest from the corporate sector, from high yield and investment grade issuers alike.
Yeah, and certainly the accounting change that we saw a couple of years ago really has helped as companies no longer have to record phantom interest on their income statement and are able to record their converts with the true underlying cost of that coupon versus having to record that phantom interest. And that certainly makes it a lot more attractive for investment grade issuers. So hopefully, we'll continue to see more issuance over the next couple of quarters from that part of the world. On the utility side, we were fortunate enough to be a book runner on 3 of the 4 issuances in the utility sector, which were the first issuances in utilities on the convertible bond side in 15 years. It was interesting to me that each of those companies approached things a little differently. You had PP&L, which really just wanted a minimal cost of capital. So they did a 5-year piece of paper with a 22.5% conversion premium. So not really as concerned about the dilution on the back end. But then you saw the other 3 companies really go for 3-year pieces of paper that were very much for debt replacement, whether it was, in an equivalent investment grade bond or commercial paper. How do you think going forward people might approach using the convertible instrument as a replacement or substitute for other alternatives that are out there in the market?
Sure. As we stand here in the second week of the new quarter, Q2 of 2023, I think what we're going to see a lot of is very proactive liability management. There is a tremendous amount of debt coming due over the next 4 to 6 quarters, both in the convertible market and in the straight debt market, that will need to be refinanced. And what we're seeing is companies not wait, and we are recommending that companies not wait until the very last minute and take refinancing risk. The markets are open. Rates will vary depending on the day, but we are going to see companies take advantage and refinance debt early on in the process. Coupled with that is the fact that a lot of the debt that companies are refinancing is trading below par. This is given that interest rates have risen, the dynamic that we see. So taking advantage again of executing these liability management trades early on is what investors are going to reward, and therefore we do expect it to be the bulk of the activity.
Given all that, I think in Q2 and going forward, we're going to continue to see investment grade issuers come to market. We're seeing significant institutional demand for the paper. In fact, our desk continues to get inbound calls from institutional investors suggesting issuers in the investment grade space that should come to the market. And as you pointed out, I think on the liability management side, with so many companies having issued in 2020 and 21 at 0% coupons in sizable deals whose bonds are now trading in the 60s or 70s, I think we're going to see a lot of companies look to use liability management to retire some of those bonds early and push out their maturity schedule. in today's interest rate environment.
Yeah, absolutely. I think that we're expecting a big wave of refinancings. Q2, Q3 are going to be busy months as we start proactively refinancing the wave that is coming due over the next, 12 months, 18 months.
That's great. Well, Mariano, look, thanks a lot for the time today, and thanks everybody for your time.
Thank you.